This is a quick video to show how to compare an investment in a rental property to that same identical investment in the stock market. There are a lot of factors to consider when choosing between investment types. Most of them are not directly quantifiable and depend on personal preference, risk tolerance, volatility, liquidity, and many more. There are already a lot of great resources available for the non-quantifiable differences. However, I couldn't find any good resources with a purely mathematical comparison between the two. This video is focused on just the numbers. There are numerous calculations and terms used to compare financial investments, such as cap rate, net operating income, return on investment, cash-on-cash return, compound annual growth rate, and internal rate of return, just to name a few. But which of these are actually useful when comparing different asset classes? For this example, I'm comparing a hypothetical $71,000 investment in a rental property versus the exact same $71,000 investment in the stock market for an identical 5-year hold period. I'm ignoring rental property income expense calculations and working with just the cash flow and sale results. Note, these numbers are made up and not actual returns. For the stock market, I'm assuming an 8% return on investment based on historical averages before adjusting for inflation. The question I want to answer is, assume we have a rental property with the return of investment of X. How does that compare to an identical investment of the same value and hold time in the stock market, assuming historical averages? This seems like it should be a fairly simple question, but it was actually more complicated than I anticipated. A typical rental property calculator will provide calculations such as cap rate, cash-on-cash return, net operating income, and internal rate of return. The cap rate, cash-on-cash, and NOI are more specific to real estate investments, so are not that useful in comparing different asset classes. This is a comparison of various investment metrics calculated for the hypothetical $71,000 investment. These values are the investment metrics for the rental property, whereas these ones are the same metrics calculated for the hypothetical stock market investment of the same value. Generally, IRR is considered to be the best calculation to compare different asset classes, as it takes into account changes in cash flow and compensates for variations in hold time. IRR is this formula shown here. It is actually a somewhat difficult equation to solve and tough to get an intuitive feel for. Essentially, it is looking at all of the cash flow for an investment over time, positive or negative, and taking into account the time value of money. For example, $1 today is not the same as $1 5 years from now due to inflation and potential investment returns from that money. The IRR is the corresponding discount rate when the net positive or the net present value is equal to 0. If you look closely, you'll notice the IRR equation is essentially the compound interest formula inverted, and instead of multiplying by the interest rate, it multiplies the periodic cash flows by the discount rate to account for the time value of money. As an example of the time value of money, imagine Sally invests $100 today and earns a 10% annual return. After adjusting for inflation of 2%, her equivalent return is 8%. On year 1, she will have $108. On year 2, $116, and on year 3, $126. And it would continue to grow at an increasing rate due to compound interest. Therefore, $100 today is much more valuable than $100 in the future. That is what the IRR equation is accounting for. However, there is one large issue with this calculation. It oversimplifies cash flow reinvestment. With the stock market investment, there are two cash flow events: when the money is invested on year 1 and when the money is withdrawn on year 5. For this example, I'm assuming an investment in a low-cost index fund tracking the total market index, compounding at a historical rate of 8%. With the rental property investment, there are cash flow events every month. The cash flow is the money after all expenses have been paid: maintenance, insurance, mortgage, management, utilities, etc. And any reserves have been set aside. It is essentially the profit or take-home cash from the property. Therefore, there are 60 cash flow events for the 5-year period, 12 months times 5 years. The IRR calculation assumes the cash flow is reinvested at the same rate as the current investment, when in reality this might not be the case. I demonstrate that with numbers here. In my example, I assumed at each monthly cash flow event, the cash was immediately invested in the stock market at the 8% return per year, shown here in these two columns. In my example, I calculated the total amount of capital earned from cash flow reinvestment and added that to the total return for the rental property. For this example, you can see before considering cash flow reinvestment, the stock market has the higher total return, with a total ROI of $104,000 compared to the $96,000 for the rental property. However, after adjusting for cash flow reinvestment, the rental property has a higher total return. The rental property return is now $105,000 compared to the stock market of $104,000. As you can see, the IRR assumes the monthly cash flows are reinvested at the same rate as the current investment, which might not be the case. There's another investment formula that addresses the shortfall of the IRR equation. This is the MIRR, or Modified Internal Rate of Return. It is essentially the same as the IRR, but requires the user to specify financing rate and reinvestment rate. This allows the reinvestment rate to be specified differently than the rate of return of the current investment. In our example, this is set to the same 8% as the expected stock market returns. As you can see in these comparisons, the MIR is slightly less than the IRR. Another small detail to note here is the comparison of the IRR calculated for monthly cash flow distributions versus yearly cash flow distributions. The difference here is almost a full percent. Most online calculators use the yearly distribution calculation, even though in reality rental properties provide monthly cash flow distributions. From these comparisons, we can see which metrics are the most useful for comparing the two investment vehicles. The most accurate is the ROI. The ROI from the rental property is clearly better than the stock market, with a total return of $105,000 compared to the $104,000. The ROI is the true return, that is the exact amount of money you would have at the end of 5 years, assuming all of your assumptions are correct. We can see here that the IRR and MIRR are slightly less for the rental property, even though the true actual cash return is greater. However, calculating the full ROI requires a lot more work than calculating the simple IRR or MIRR, which we can see are very similar as we would expect. This is why IRR is often used to compare investments in different asset classes. So what are the takeaways from this video? Takeaway number 1, the best method to compare a stock market investment to a real estate investment is really to do a full return on investment study where you thoroughly estimate cash flow distributions and reinvestment rates. However, in reality, this is difficult and time consuming, so the IRR and MIRR calculations are often used to do a quick comparison. But it's important to keep in mind that this is not a direct one-to-one comparison. There are nuances in cash flow reinvesting that can change the results. Takeaway number 2, the IRR calculators on most online rental property calculators actually underestimates the true ROI of rental properties, assuming you have a solid cash flow reinvestment plan, or it can significantly overestimate if you don't have a cash flow reinvestment plan at all. Thanks for watching. Please like and subscribe for more content.